do you need to do some roll call, or do you have a list of who's here?
No, I think we're good to go. So I think whenever Greg is ready.
Okay.
Are the slides displayed?
Not yet.
No.
No.
Click the slideshow. No. Come back where you were. Second one down on the left. Click the slideshow. Now click the right button that says share.
Are they displayed now?
Yes.
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 Greg.
Okay.
Yes.
Well, thank you. Good morning, and thank you for attending today. We're in the process of revising the fiscal 22 current year estimate plus the 23-24 biennium. By statute, these are called the preliminary estimates, and they're due by October 15th pursuant to statute. Just want to remind everybody that today is not an official revision to the revenue estimates. It's their preliminary estimates. The official estimates will be done hopefully in December pursuant to statute as well. Today our focus is for the most part going to be on changes from August to October. You know, what has changed, and really. Let me advance my slide here. Really, what has changed from the first quarter is two things. The biggest thing in terms of moving the numbers was the first quarter receipts were added to the history of our dependent variables. And in some taxes that made a profound impact, in others not as much as maybe but certainly for sales and corporate and the ubiquitous other category, the first quarter receipts were very instrumental in changing those numbers. And secondly, we updated the economic outlook from IHS Markit. In August, we used the July economic outlook so that we could get our materials ready for August. In October, we're using the September economic outlook. October is available now, but we had deadlines for the presentation materials and we weren't able to incorporate it. So that's what's changed. The impact on the first quarter was pretty dramatic on first quarter receipts. The general fund grew by 35% in September and 20% in the first quarter. The 35% in September was heavily influenced by a one-time cash inflow of $225 million pursuant to a legal settlement with Flutter Entertainment, which is the parent company of PokerStars. You probably heard of that pending action. It's been in the works for quite some time, and we finally got our money, the $225 million. So as a result of that, September was up 35%. Without the settlement, general fund growth would have been 14.8% in September and 12.1% year to date. So the 14.8% in September is on top of the 12.5% we got in August and the 8.4% we got in July. So we had a really nice quarter of 12.1% growth. And the main amount of growth came in our biggest three taxes. The sales tax grew 10.8% or in September, and then 9.9% in the first quarter. The individual income tax grew 7.6% in September and 6.5% for the first quarter. And business taxes grew 55.8% in September and 76% for the first quarter. So profound growth in business taxes. I think you all are on the list of the receipts report, getting the press releases, and you can see if you had a chance to look at the press release, what we had to say about it. But generally speaking, it was good for the Commonwealth to get the legal settlement, but we were equally happy with the 14.8% in the underlying taxes in the general fund. In terms of the road fund, we had a nice month, 5% in September and 3.5% in the first quarter. Motor fuels grew 5.8%, which is really good growth in fuels, and 4.9% for the first quarter. And motor vehicle usage grew 4.8% in September and 3.8% in the first quarter. So good growth in 84% of our road fund, which is fuels and usage. Just a few highlights. Sales, individual, and business taxes, combined business taxes, are 89.8% of total tax receipts in the first quarter. Notice I said tax receipts instead of general fund revenues because I wanted to not get the settlement money mixed in. So 89.8% of tax receipts are from the big three taxes. Collectively, that set of taxes grew 12.7% in the first quarter compared to 12.3% in overall growth in tax receipts. The non-big three taxes, the remaining 10.2% of the general fund grew at a very respectable 8.5% collectively through the first quarter. So no taxes were sort of left behind in the first quarter. This graph is a little bit out of place. I'm going to talk a little bit more about this a little bit later in the presentation, so I'm not going to talk much now. But what I was trying to convey in this is that if you look at the blue columns, which are fiscal 21, you can see that the growth in fiscal 21 was a little bit backloaded. What I posted was nominal growth. So when you see the big $506.5 million in April, that's nominal growth over the prior April. And then the 442.6 in May is nominal growth over the prior May. So you can see that I kind of made this point in August that the second half of the year really took off in terms of nominal growth. And when we go through the tax part of the presentation, I just wanted to set the stage that the second half of the year is going to be comparing to some months that had a lot of fiscal stimulus and had good growth in fiscal 21. That's really all I had. Just to summarize, these are not, after we go through the economic slides and get to the revenue slides, we're not, these won't be official revisions. They'll just be another set of data for the three branches of government to look at as they prepare budgets. But the official run will be the next meeting of the CFG. So with that, I'm going to turn it over to Dr. Michael Jones, who's going to talk about the national and state economies.
Thank you, Greg. Good morning, everyone. As Greg said, we're going to focus mostly on the changes that have occurred since the last time we spoke and the differences between the current forecast and what was presented in the August meeting. Oh, screen sharing has stopped. We don't want that. Are the slides back on the screen?
Not yet.
It's loading. There it goes.
Excellent. Well, the key difference is what has changed since IHS Markit, since we presented their forecast last time, is the revision downward of real GDP estimates. This is due to the ongoing Delta variant spreading and reducing consumer activity, and of course, just general concerns. Some locales are starting to put back on some of the restrictions, and further cuts due to the in GDP due to production issues, specifically with vehicles, but with lots of other manufactured items too, as there continues to be supply chain issues, specifically shortages of computer chips, but also availability of other inputs, especially those produced in China, that have to be shipped over. The inflation forecast compared to last time has stabilized. The headline PCE inflation measures are held constant at 2.1% for both fiscal years 23 and 24. And they believe that most things are starting to level out due to the recovering supply issues concerning food and other energy products, and that the long run inflation rate will be near the Fed's target of 2%. And for the first time, the Infrastructure Investment and Jobs Act is being included. However, the impact of that is quite muted in the near term. The vast majority of that was already included in prior forecasts due to the authorization spending on a lot of the road fund type projects. And so the bulk of the impact of that act will not be until approximately fiscal 25 and 26. So outside the range of our current forecast. Let's see if we can. There we go. Okay, so what's in the control scenario? So weighted at 50%, GDP growth is forecasted to rise 5.1 and 3.4% respectively. That is a slight reduction in the current year and a shift out to the out year, again, focusing on that inventory building, investments that are being made that are going to be delayed because of the supply chain issues. So again, most of the growth that is being taken out of fiscal 22 is being assumed to shift forward into fiscal 23. The assumption will be the federal funds rate will not change, be held near zero through at least the first quarter of fiscal 23, but with asset purchases tapering over the next 12 months. And they assume that Brent oil prices are expected to be in the $69 and $67 range respectively. Now, of course, we've seen what's happened with oil prices recently. So we know this is slightly below where current markets are experiencing disruptions on the world market for oil. In the optimistic scenario, stronger GDP growth of 6.7% and 4.5%. Again, that the assumption in the optimistic scenario is always get COVID under control. Consumers respond by increasing their activities and fully utilizing all stimulus that is provided under all the different programs. Increases in employment stronger than that within the control forecast. Better unemployment rates, consumer spending increases by 7.6% versus approximately 5% in the control. And the overall economy globally recovers from COVID much faster than in the baseline forecast. The flip side of that, of course, is the pessimistic scenario. Now, it's only weighted at 30%. But it does assume that GDP would have rather tepid growth compared to the very high growth that's been assumed in the previous control scenarios, and certainly relative to August. But the idea in the pessimistic scenario is the resurgent virus, and we have a large increase in cases and hospitalizations. And then, of course, employment is continued to be impacted due to a lack of availability in childcare and delayed in school availability. Consumer spending growth rather tepid compared to the other control forecasts, certainly what was presented in August, 3.9 and 2.4% respectively. Again, that consumer hesitancy, employment increases at a relatively moderate rate, unemployment at 4.3 versus the 4% in the control forecast. And again, just continued setbacks on the world stage overall as COVID continues to be what is essentially driving the economy as everyone responds to that. So in the case of the individual variables, I'll go through these very quickly because, again, we're going to focus mostly on the differences. So in real GDP, you can see by the slope of the lines that even in the control forecast, that growth is being shifted out into the out years compared to what was presented last time. Strong growth in the optimistic side, and the pessimistic is a relatively tepid continued growth. So here specifically is the slides where we show August will be in red, and it'll be the column to your left as you view the screen. The current forecast is in the right. And so again, you can see for fiscal 22, 5.1% in the current control forecast versus 6.7% in August. And then we have a reversal where we again are taking growth out of the current year, shifting it out. So in the current control forecast, 3.4% in 23, 2.7%. So stronger in the out years versus a near-term reduction for FY22. And this is something that we'll be repeating, or I will be repeating as we go through several of these variables. Non-farm payrolls, again, coming off that tremendous experience with COVID, strong growth in the optimistic, but still fairly strong growth in the control with a slightly reduced growth in the pessimistic side. Again, compared to last time, slightly reduced growth in the current year versus a holding steady in 23, but slightly better growth in 24. Manufacturing employment, again, they're really building in the impact of these supply chains disruptions. So you can see that we have a lot of shifting of what will be happening as we go out. And that's specifically, you can see here in compared to August, slightly reduced growth current, again, shifting it out into 2023, slightly more growth. And then again, all forecasts have it declining in 24, but less decline in the current forecast coming off of 23. Real personal income, again, those large blips, of course, in the history are based on the transfer payments and the COVID relief funds that were distributed. And then pretty much all of the growths have relatively similar slopes as we go out into the out years. But you can see compared to last time, a bigger drop off in current and then more growth in 23 and 24. So again, falling 2.7% in the current fiscal year, but then flipping right around and growing at 2.7 and 3.2 respectively, as opposed to a more steady state that was forecasted in August of 2.4 and 2.2% in the out years respectively. Wage and salary disbursements, very similar to the income, not a lot of difference in the growth rates between the optimistic and the control, but the pessimistic is starting to slope downwards in the out years. Compared to last time, again, slight pullback. I will say, pointing out fiscal 21, the BEA did several adjustments, and rather than force things to match for history, we thought it would be best to go ahead and show the actual BEA estimates for the growth rates that IHS uses. So apparently 2021, after the adjustments, wasn't quite as strong as we thought based on those adjustments for fiscal 21. So then comparing that to where we are, we see a slight reduction in fiscal 22, but again, much like some of the other variables, a shift in growth out to 23 and 24 at 6.1 and 5.2% respectively. Real consumer spending, and there's no doubt that we know that IHS Markit really focuses on consumer spending being the real driver for what is going to help us move past the whole COVID experience and keep the economy on track. And so you can see that strong growth in the optimistic forecast. The control is pretty much a steady state continuance of the long-term trend, but again, pessimistic dipping down and then recovering. And you can see that again as we narrow in on the differences between what was presented in August versus now. So again, a pullback in the current year, still continuing to have less growth than what was presented in 23 for fiscal 23 compared to what was presented in August, 3% versus 4.1%, but then growing in the out year, a 3% increase for fiscal 24 versus the 2.6% that was presented last time. We don't put the control optimistic pessimistic line for the chain price index, but again, given the discussions of inflation that are certainly everywhere in both the popular press and of course the business and economic press, we wanted to show the different assumptions. Now, this is the assumed growth rate in the chain price index for the control optimistic and pessimistic scenario. So in the current forecast, you can see in the control 3.5, 2.1, 2.1, like I mentioned before, assuming stronger growth for this current fiscal year and then leveling off, holding at 2.1%, again, near the Federal Reserve's target 2% rate. And that is strongly different than the optimistic scenario, at least strongly different in the world of inflation, where we have 3.6% in the current year and then declining 2.4, 2.2. versus the pessimistic forecast, lower in the current year of 3.1, and then very low for 23 and 24, 1.1 and 0.9% respectively. I'm just going to talk about the control forecast for the price index. When we met in August, we were looking at 3% versus 3.5 in the current forecast, and then slight differences. Last time it was almost exactly 2% for each of the out years. This time it's 2.1% in each of the out years. So not as much of a difference in the control forecast compared to what was presented in August. Consumption of gasoline and oil, again, about what you would expect, strong, relatively strong consumption in the optimistic, as compared to the control, and then again, a drop off in the pessimistic scenario. Compared to last time, though, extremely strong growth in the current year, 27.4%. Now, of course, this is nominal consumption. This is not gallonage, this is price paid. So 27.4% in 22 versus 18.9% last time. Larger drop off forecasted in 23 at 3.1% with a slight increase in 24 of 0.3%. And that compares respectively to 2 years of declines that were forecasted in August, 1.4 and 0.2% respectively. Light vehicle sales, obviously very important to Kentucky. The supply disruptions have really changed this forecast. If you can't make them, you can't sell them. So there's a lot of pressure to continue to work through these supply issues so that light vehicle sales can continue their rapid growth that we've seen since COVID. And you can see the optimistic, very strong growth in the optimistic forecast versus a significant decline relative in terms of growth rates in the pessimistic scenario. So specifically last time, we were expecting a 1.9% growth in the current fiscal year, and that is now changed to a 4.6 decline. And again, much like the GDP, it's this in an extreme measure. Now, instead of having the slight pullback from 1.9 to 1.2, which was presented last time, now we're talking about a 4.6% decline in the current fiscal year and a very strong 8.1% growth in fiscal 23. So again, supply chain issues pushing out economic activity that was expected to occur. It's being shifted out to the out years. But in both forecasts, both in August and the current forecast, 0% growth off of those levels for fiscal of 24. Exports of goods and services, not a lot of difference, obviously, between the control optimistic and pessimistic. When you compare the actual forecast, though, you can see in the percentages, again, pullback in 22, growth shifted to the out years, 8 and 6.5% respectively in 23 and 24, stronger growth than was presented in August. And specifically, real exports of motor vehicle parts, a similar tale. You can see that, again, pullback in the current year, 12.7% versus a 17.5% presented in August. Again, more growth in 23 and then less of a decline in 24 as a 0.7% versus 2.4% pullback, which was presented in August. Now, I know I went through all of those rather quickly, but again, we're trying to focus mostly on the differences between the two. Is there any questions from the group on any of the IHS market assumptions or any of the variables specifically?
I'm curious when they release these market forecasts.
Approximately the second week of the month. So this would have been released the second week of September. I'm sure, of course, the work that they do that goes into it is during the month of August for them to be able to make their date. But you're right. I hate to say we're driving by looking through the rearview mirror, but in many cases, the IHS market forecast that we use to build our internal forecast is going to be delayed by approximately 4 to 5 weeks in terms of what we're experiencing now. And you're absolutely correct. I mean, think about the news we just got this week on the inflation numbers, the JOLTS numbers. It was quite a jolt to hear that 4 million people decided to quit from their jobs. That's an all-time record. So there's always things moving forward, but unfortunately, that's one thing that we just have to deal with given the nature of time and when these forecasts are made available and the production time we have internally. I'm going to stop the share in the slideshow and then switch to states. State economy. Start slideshow. Whoops. Come over to here. should be sharing screen now.
Mhm.
Thank you. Well, specifically, of course, we take the IHS market, combine it with the Kentucky data, and build a Kentucky economic outlook. And so what are the key differences in the current forecast? Well, the current fiscal year employment growth estimate has declined. The IHS market, the existing conditions in Kentucky. So the largest impact for this is in manufacturing employment, which is not surprising. Everything that we've talked about and seen at the national level, supply chain issues, that is clearly going to impact the manufacturing employment in Kentucky. So we have a decline to 2.9% from our previous estimate of 3.9%. So a 1% overall decline in the estimated growth in manufacturing employment in the current fiscal year. And again, due to the supply chain issues. But much like we've talked about with the national issues, this is being shifted out to fiscal 23 and 24. So we have non-farm employment increasing in the out years, and of course, a strong increase in the manufacturing employment, again, feeding off of the inputs from the IHS market forecast. And we've seen wage and salary growth estimates increase. We've seen, historically low labor force participation rates. Like I would just mention the JOLTS data, we've seen a lot of people moving around, finding better employment, moving away from jobs which have more variation in the income, such as restaurants and hospitality businesses, moving towards firms like Amazon and other more, I shouldn't say stable, that's not the right word. Jobs that have more consistent hours that don't require as many fluctuations or need for childcare at last minute notifications. So again, the underlying forecast that goes into our wage and salaries forecast, the IHS market forecast specifically, is assuming it will be 2 more years before we get to pre-pandemic levels of labor force participation. There's been a lot of concern about where we are in labor force participation in the Commonwealth. I think, however, many people who are concerned about the current number are unaware of the historical number. I know I've heard legislative members express surprise, but I think they may not be aware of that we have been in a long-term range of low 60% labor force participation. So the current mid-50s rate is certainly low, but not as low as I think they're comparing, because we're certainly never going to be in the 70-75% labor force participation rate. So here's the Kentucky non-farm employment. Again, much like the national levels, continued recovery in the control forecast, strong growth in the optimistic, as judged by the slope of that line, and relatively tepid growth in the pessimistic forecast. Compared to the United States as a whole, the U.S. is listed as signified by the red color. We're of course in Kentucky blue, and you can see that for the current years going forward, we are lower than the assumed growth rate at the national level in all fiscal years. Compared to what was presented last time, so again, that pullback in the current 3.9 versus 4.1, and then growth in the out years 2.2 and 1.1% respectively, as compared to 2.1 and the 0.8% in fiscal 24 that was presented in August. Manufacturing follows the same general trends, but as we look at the specific numbers, we are stronger than the US as a whole, 2.9% for fiscal 22 versus a national 2.1%. And the biggest surprise of all, 0.8% growth forecasted in 2024 versus a pullback on the national numbers as a whole. And compared to last time, again, pullback in the current year, fiscal 22 at 2.9%, but stronger growth 2.3 and 0.8% in the out year versus the relatively tepid growth in 23 and the actual pullback we had forecasted in August of 0.1%. Personal income, much like the national numbers, we've had those large spikes due to the COVID relief payments, and then continued relatively consistent growth in the out years, obviously slower growth forecasted in the pessimistic forecast. Again, in this situation, we are less than or expected to have lower growth in the US as a whole, 0.3% in the current year versus 0.8 for the national, and then 3.5 and 4.2% respectively, as opposed to the estimated numbers for the national personal income growth. Wages and salaries. Similar to income, the control and optimistic very similar in the forecast, but definitely a pullback in the growth rate assumed for the pessimistic forecast. Again, in this case, once again, we are less than what is being forecasted in the out years for the US as a whole, slightly better than the national estimate and the control forecast in the current year, 8.3 versus 8.2%, but then in the out years, slower growth. Compared to what was presented last time, again, that shift, doing a little better in the current, but then more growth going out in the future on wages and salaries, 5.2% in 23 and 4.1% in 24 versus what was presented in August at 4.5 and 3.6%. Transfer payments, always been a big part of the Kentucky economy, and certainly that is the case during the COVID experience, significant increase in Kentucky transfer payments. And you can see compared to what was presented last time, less of a decrease in the current year, declining 13.5% off of the enormous growth in 21 for transfer payments. That is better than the 15.7% that was forecasted in August. And then a relatively slight decline of 0.4% versus the 1.7% growth that was forecasted in August for 23. And then a slight change in the out year of 24 at 3.7 versus 3.9%. And so once again, I did go through those relatively quickly, but we're trying to move things along. But if there's any questions, I, of course, would be happy to answer them.
Michael, I have one question.
Yes.
And I don't know if this is the model or the data again. So I usually ask this almost every time. I think maybe I'm just forgetting almost every time. So I noticed on like the Kentucky wages and income, it seems like one of the few graphs that if you absent COVID, if you drew like a trend line, the wages and income look like they inflect up, but almost everything else looks like it inflects down, manufacturing, employment, and different things. Is there a reason why for the next year, 2, 3, 4, 5 years that wages and income in the Kentucky are looking like they're like above, the trend for say the last 10 years or something like that?
I would have to say the strongest reason is that shift that is assumed in the model, that there is going to be a significant increase in wages and salaries, relatively strength of labor, but again, pulling away from the current and moving out, especially in manufacturing. So assuming that the wages and activity are associated with that shift, that due to supply constraints, we've had this forecasted pullback, but then strong growth going out. And the idea being that as we recover and they go to make up time, wages and certainly hours of work will be growing significantly in the out years to make up for that pullback in the current. It would be my understanding of what IHS market, and therefore as that fills into the Kentucky data, how it builds into our current model.
Yeah, because I didn't know if it was back to your labor force participation. We're lower. Lots of places are lower.
We are.
And we're lower. So I don't know if it's getting back to normal over the next few years, if that's why it's going up. I'm just surprised that Kentucky is looking like it's going to inflect up in wages and income. And I only ask because I think that's like close to half or so of our revenue that we get. So I just want to make sure that there's not something I'm missing.
No, and again, I think a lot of it has been this movement, this shift from the more volatile areas like hospitality, and certainly restaurant and hospitality, as people say, I can guarantee I'm going to start at $15 an hour at Amazon. I'll have more of a set schedule. There'll be less fluctuation, so I can more easily dial in my childcare, know what I need, versus the vagaries of, is this restaurant going to be open? And I know there's a lot of anecdotal evidence of this, whether it's people saying, I went to the local Panera, I can't believe it's closed. All they're doing is drive through. They don't have enough workers. And so we're seeing a lot of firms respond. And I did learn a new phrase in the Beige report. I had never heard of the phrase coast and ghost. And this is employers reporting that someone comes in, they receive the training, and then they shop around for a better deal. Who's going to give me better wages based on what I've learned? So I coast through the training and then I ghost the firm. And of course, as a former labor economics teacher, I always loved teaching about specific versus general human capital attainment. And I thought, well, that's pretty tricky for someone to come in, learn a new skill, and then ghost the employer, as they can immediately turn around and say, I know how to do this task. Who's going to pay me the most for this? Now, I assume that much like everything in the Beige book, that is more anecdotal than a general trend. But as we always joke, the plural of anecdote is data. And so I do think the underlying model is assuming that, the folks that are remaining in the labor force, we've seen a lot of people taking retirement, a lot of people moving up decisions to exit labor force. And I think the assumption would be the underlying folks that remain in the labor force, as long as they can get schools open, so they have childcare taken care of either directly or through the school system, and we can get past COVID and a lot of the restrictions, I think people are trying to move towards a more stable employment situation. And in many cases, that is associated with an increase in wages. I know UPS in many places is offering a weekly retention bonus, starting salaries over $15 an hour. And every week when you come back to us, we'll give you an extra $100. So clearly employers are responding by trying to maintain that workforce and certainly not have people leave, because we all know that turnover for any business is expensive, but anything that involves training, it's even more so. So I think all of that is being built in, and that is what is being assumed going out. I know Dr. Bollinger and I had been speaking about, I think it was Chris and I were speaking about the wages his son had received in a job. And he was saying that he thought his son was kind of surprised at the wage he was receiving. And so, again, I could be thinking, I might have had the conversation with someone else. I apologize. But anyway, point being, overall, even beginning wages are growing. And certainly retention wages are also increasing. And every employer is learning, if you raise your starting wage significantly and do not pass along similar wage increases to your existing employees, you may lose them. So I think all of that is what is going into these growths and stronger wage and salary estimates. I apologize for the long answer. Is there anything else? All right, in that case, I will exit out of this screen. Is it already open? All revenue slides. Start this. Oh, sorry, I do this backwards every time. Let me go back to here. Share screen. I am confident we will get this by December. Okay. Come over here. All revenues, PowerPoint, share. Okay, I think. Did I do that wrong this time? Oh. I think it's sharing the wrong one. I'm sorry, I apologize. Let me try this.
Individual was on the screen, Michael.
Oh, it was?
It was, but it wasn't maximized.
Okay. Oh, PowerPoint, all revenue, share. Let's see, is it maximized this time?
It's loading. Yes, now it's correct.
Excellent.
Now it's correct. Can y'all hear me?
Yes.
Excellent.
You're going to toggle. Okay. Greg is going to toggle slides. Thank you so much.
All righty.
Talk to you later.
So let's shift gears into the individual taxes, starting with individual income tax. Next slide, please. Here's a little bit of the history, including the most recent quarter that was recently completed. The drop in FY19 was caused by tax legislation that lowered all individual income receipts, but it was primarily focused in the withholding category. And then in FY20, receipts growth picked up right where it left off in FY18 and improved significantly. Growth in FY21 occurred across withholding, declarations, and net returns. That strong growth then continued in the first quarter of fiscal 22. In the first quarter of 22, withholding grew by 5.3%. Net returns grew by a nominal $17 million. As you recall, net returns is usually, it averages the expected value of first quarter receipts for net returns is right around zero. It's not a big returns pays or refund season. The same is true of the second quarter of the fiscal year. So we will not be expecting any significant monies in the net returns bucket in the next 3 months as well. So we're really not going to be getting very much new information for net returns in the next couple of months. So it's very important that we hammer down net returns forecast this go round. Declarations in the first quarter of 22 grew by 4.2%, and fiduciary declined by $1 million. So that's the breakup of FY22, the first quarter. Next slide, please. The methodology that I'm using for the 4 components is very similar to what I used in August. The withholding forecast specification is exactly the same as in August. Declarations is exactly the same as in August. This $20 million is a one-time adjustment that is applied to FY22 only. Next slide, please. Now, net returns, you'll see, is significantly different than what we did in August. I did a deep dive and evaluated what happened with the pays and refunds for the last few years. We also examined how the tax laws have impacted returns. And we also took a closer look at how UI, the withholding and the impact on net returns was affecting the most recent receipts. And we came up with our net returns forecast based on that evaluation. So you'll see that of all the components, it's the one that's changed the most. And the fiduciary is just a very simple 3-year moving average. Next slide, please. This is the same slide that Michael showed you a moment ago, Kentucky wages and salary. You can see that the control and optimistic are very similar, and the pessimistic lies slightly below, but all 3 of them have a greater slope than they did in FY18. Next slide, please. And here you can see the withholding forecast for the control, pessimistic, and optimistic scenarios. I did not put the FY18 growth rate on there, but it was around 2%. Withholding was growing around 2% for the previous 3 years prior to FY19. So you can see that for the out years, 22, 23, and 24, growth is higher than it was in the previous, I guess, hegemony. 4.2% in 23 and 3.4%. So it's tapering a little bit in the out years. Next slide, please. And here's the differences compared to what we presented in August. You can see the differences are very small. Those are millions of dollars in the far right corner. The IHS Markit changed their forecast for US wages and salary, and therefore Kentucky wages and salary, very little in the last 2 months. So as a result, there's very little change in our withholding forecast. Next slide, please. The declarations forecast is the same, very little difference compared to August. Really, the only difference here is the inclusion of the new first quarter observation to the data. So we've just got a little bit more information about what happened in the past, and that's the only difference that's showing up here. Next slide, please. So from 2009 to fiscal 18, net returns was hovering in the -241 to -350 range. So if we were somewhere in that band with our forecast, we knew we were doing pretty good. But in the last couple of years, that range has greatly expanded. So we had to really take a close look at what's going on with net returns. And we believe that the tax law changes that occurred in 2019 are having a significant impact, and those are not going to go away. That was, as you recall, the elimination of several itemized deductions. And since that has not gone away, we believe that that's going to have a long impact on the net returns forecast. So you can see that we've got -50 million for FY22, and then improving very slightly to -49 million in 23 and -48 million in 24. So we've acknowledged the tax law changes, examined pays and refunds, adjustments for UI withholding, and we took a close look at how the itemized deductions were impacting tax returns. Higher amounts of income on the 1099 will also affect the net returns data as well. The change that you see there, that -2%, is actually growth because it's negative numbers. So that slight growth in net returns in 23 and 24 is purely based on the trend that we were seeing in refunds and pays. So that's just a very small growth impact there. Next slide, please. And fiduciary is as you remember, a simple 3-year moving average. So this is just the inclusion of the most recent quarter of data. It's important to note historically that fiduciary usually runs negative for the first 3 quarters of the month, 3 quarters of the year, I'm sorry, and then has all of those pay returns occur in the 4th quarter. And so what usually happens is it's running slightly negative, and then we get all of the payments in the 4th quarter, and that leads to a positive account balance for the year. However, in FY21, we had a few taxpayers who had refunds from prior years that impacted that 4th quarter payment and caused the entire year to be negative. That's what happened for the FY21. That's why it's negative. But going forward, I eliminated that because that was a one-time event. So the moving average does not include those one-time refund events that occurred in the 4th quarter of FY21. So that's why you see the slightly larger numbers in FY22 and 23 and 24. Next slide, please. Here are the legislative adjustments. These are exactly the same as you saw in August. Next slide, please. And here's the sum of all 4 components. I should say the normal 4 components of individual plus the tax legislation changes are all on in the 2nd column, October control. And you can see the result is 2.5% growth in 22, 3.4% in 23, and 3.6% in 24. And this, like I said, this includes all the tax law changes are already in those figures. Mr. Chairman, that's all I have for individual. Are there any questions?
Thanks.
I covered a lot of ground. I just wanted to make sure everybody had understood everything.
Right.
Shall we move on to Cole?
Sure.
Okay. Advance 2 slides, please. So here's a little bit of history on coal. Coal receipts peaked in fiscal 12 with $298 million in receipts. Every year since then, coal receipts have declined. You can see there in FY19 that there's a positive number showing, but that was because of a couple of taxpayers who made one-time payments in the very last month of the fiscal year for prior tax years. So that is not a fiscal 19 event. They were paying on prior tax years, and they made I can't tell you the exact amount of money that they paid, but you can deduce that it was greater than the difference between 19 and 18. So that's the reason for the positive showing for FY19, but receipts have declined every year since fiscal 12. The 2nd quarter of FY21 grew by 12.7%, and the 4th quarter of FY21 grew by 29.2%. And you can see here in FY22 quarter 1, receipts grew by 6.1%. Those are real. The Central Appalachia prices during that time have risen, and that's the main reason for the receipts increase in the recent history. Meanwhile, the Illinois Basin coal prices have increased very, very slightly. I'm talking about pennies in the last month and a half. So that helped contribute to the increase in the last quarter. Severed tons, for the most part, have still been declining, except for the 4th quarter, when severed tons increased by 16.7%. Other than that one quarter, severed tons have been declining in the state. Keep in mind that severed tons are hovering right near all-time lows. Last quarter, we severed 6.8 million tons. That's for the entire state for the entire quarter. The all-time low was set 5 quarters ago with 5.8 million tons severed for the entire quarter. I remember just as recently as 15 years ago, we had one county severing that much for the quarter. So it's a considerable difference in the amount of severed tons. Next slide, please. Here's an overall summary of what's going on in the energy markets. We're going to take a closer look at each one of these series, the coal prices, natural gas prices, and the oil prices in just a moment. What you want to focus on here is natural gas prices are expected to rise for most of our forecast horizon. Oil prices are expected to rise for the next couple of quarters and then taper off. And I already told you about the Central Appalachian prices. Next slide, please. This is a very similar methodology to what I've been using for many years. The only difference to August is my income variable. Instead of using real GDP, as I did in August, real consumer spending on durables was a superior variable in the model specification process. Next slide, please. The differences in model specification, I use the Aki-Iki criterion to determine which is the best model. They were extremely close. I could have easily continued to use real GDP, but this real consumer spending variable was just ever so slightly better. And in the long run, or I should say, as far as IHS is concerned, they've produced forecasts for those two series, which behave very similarly. So it really doesn't make a lot of difference. Here, let's take a look at the prices for coal. Now remember that this is the aggregate price for all coal types in the state. And you can see that for the first year and a half of our forecast horizon, all three scenarios are very similar. And then they split ever so slightly in the out years. Next slide, please. Here's oil. Again, the three scenarios lie nearly on top of each other again. Even in out to FY24, the prices are very similar, hovering right just above $60 a barrel. Next slide, please. Here's the Henry Hub price of natural gas. The prices are almost on top of each other, depending on which. I tried to play with this. It was odd to me that the pessimistic scenario is the one that lights up here in red. I played around with it and thought that maybe this was an issue of how I added them in Excel. So I did it all three different ways to put each one of the series, adding it to the slides, and it didn't make any difference. Somehow the pessimistic scenario shows up on top here like this all the time. But they're nearly on top of each other for every single quarter of the forecast horizon. And you can see that they rise slightly in the short term and then decline over our forecast horizon. Next slide, please. Consumer spending on durables. Here we can see a little bit of differentiation between the three scenarios, a classic differentiation. The optimistic is higher and the pessimistic is a little bit lower. In all three scenarios, we see a small decline or a fairly significant decline in the very short term. It bottoms out at varying times, and then it begins to rise for all three scenarios for the last 2 years of our forecast. Next slide, please. So let's take a look at what the forecast produces. We've got 14.4% growth in FY22. So this is a big turnaround for coal. And they're a little bit, IHS market is a little bit less optimistic about FY22 than they were. And that's a function of what they're saying about real consumer spending. That's what's caused that decrease in optimism for FY22. And then you can see in for FY23, 19.4%, and for 24, minus 1.8%. And I extended, just for my own edification, I extended this out. The next 2 years after that were also negative growth. That's all I have, sir.
Good, thank you. Questions, comments? Hearing none, we go on to the next.
All right, sales tax is back to me. And as I pointed out in August, we still have a lot of noise in the sales tax dependent variable. Most of the noise comes from two sources, tax reform and federal stimulus. As I'll show in the next graph, we've received a considerable amount of federal stimulus that has sustained consumer spending in the forms of direct stimulus checks, unemployment insurance, the extra 600 and 300 from the federal government as well, the payroll protection loans, the PPP loans that were forgiven in Kentucky, and most recently the child tax credit has given households income that they normally would not have had, and that puts some noise in my dependent variable. And the other source of noise, as I indicated, was tax law changes, and in calendar year 18 and 19, the General Assembly added a bunch of services, thereby creating base broadening, enhanced our ability to tax online sales, and dependent variables is supposed to have a policy, tax policy neutral basis. So if you recall, a couple of years ago, we took the fiscal impacts out, and we're forecasting a policy neutral series, but we're far enough away from tax reform that I quit doing that. So we're no longer trying to do a policy neutral with regard to tax policy dependent variable. It's my contention that the sales tax broadening is structural and will persist. It's built into the base now, so we won't see probably as prominent of growth from the sales tax broadening, but it's in the base and will persist and lead to higher nominal levels. The federal stimulus money, in my opinion, is mostly transitory, and the challenge to forecasters is trying to separate out those factors of what is structural and will persist and what is transitory. I'm going to the Federation of Tax Administrators Revenue Estimation Conference and going to participate in a panel discussion on this very issue and talk about some research we've done here and sit in and see how other states have dealt with this very factor. This is a busy slide, I'm sorry, but I wanted to make a few points. First of all, the reason some bars are red and the other bars are blue is the red bars are months where we received over $400 million in sales tax. The record for the longest time was January of 19, where we had about $384 million in sales tax, and we thought, man, that's going to stand for a long time. And then January the next year showed up, and we got over $400 million. That was pre-pandemic, remember? And then the pandemic hit, and April and May in June were down, but they weren't down as much as we thought. And I think a good bit of it is due to some of the stimulus that occurred. The $1,200 per adult in April 2020, the UI bonuses that started really quickly, the PPP loans, and then we had another round of fiscal stimulus, and then we did 300 bonus UI, and most recently we have the $300 child tax credit checks that they're distributing as a early disbursement of that tax credit. But you can see, even though we've had a resurgence of the Delta variant and so forth, that there's a lot of red in calendar year 2021, meaning there's a lot of months over $400 million. And that is going to play into what we expect for the remainder of the year. Those red months were right in the middle of fiscal stimulus, and most of that, the $1,400 per adult payment in March of 2021, that won't be around, and the disbursement that we got in December of 2020 won't be around. Maybe somebody has saved some of that money, but in general, most of the stimulus, except for the child tax credit, is expired. This just shows.
Greg,
Yeah.
Could we go back? Can I ask a question? I'm sorry.
Yeah.
Do you have so I'm looking at this, and January 19 is kind of an outlier, as you pointed out. January 20 is certainly an outlier, and that's all pre-pandemic and all response to the pandemic. And I look at January of 21, and while yes, you can argue that the $600 per adult in December probably had an impact. I mean, if you compare it to July of 20, I would have expected those to be reversed in their relationship, right? You've got $1,200 adult coming in April, and somehow it only hits in July, and it's not as big as the $600 in December that hits in January. I'm kind of wondering, has something changed? Is there something where we're shifting tax payments from December into January somehow now? And that what we're really seeing there is a seasonal effect coming off of Christmas or something? I mean, is there a structural change in how things are getting reported that maybe explains this?
That's a very good question, Dr. Bollinger. And in January, you have to remember that sales tax is 1 month in arrears. The January payments are really December activity. So unless you're a advanced filer, but January shows the majority of
Okay.
Christmas sales.
But is that new?
That is not new, no, sir. But January, in seasonal terms, is one of the higher months of the year, consistently as you go through the time series. To me, the thing you brought up about July of 2020, that was at the time, I think we reported in our press release how surprising it was, because that was June activity, and there was a lot of stuff closed up in June of 2020 in terms of June activity is July collections, and June of 2020 was a fairly lockdown time. So the July of 2020 collections over $400 million really came as a surprise to me, I know.
We were all ordering delivery food.
Exactly. Exactly.
And buying crap off of Amazon like you've never seen before. And Amazon does charge you appropriate Kentucky sales tax. So
Yes, sir. Yeah, that's true.
I mean,
it just
I'll just say, I think I alone may be responsible for your July. Yeah. I was buying a lot of stuff online.
But you should add the fulfilled by Amazon. That is
the Michael's got something here. I'm sorry.
Just keep in mind that when you order directly from Amazon, yes, we've always been collecting sales tax, but people who our orders are fulfilled by Amazon. We're using Amazon as a platform. That has been an expanded source. They previously were not collecting sales tax.
Yeah, it varied. It depended on where they had a nexus, right? And now it does not depend on that.
Correct.
That's correct, as long as they get over the minimum threshold.
I think I learned that from Greg.
Yes, I hope so. But I just thought the monthly history was somewhat telling, and that the stimulus months, we consistently had months over $400 million. And there's nothing really special about $400 million. It's just that was the gold standard for the longest time about what was a phenomenal month, and we've just been knocking them off on a fairly consistent basis during a time when COVID is still around. So I just wanted to point that out in this chart.
While we're on this, what is being assumed in the forecast about the child tax credit? It's been temporarily extended, but that will end in this fiscal year, I believe.
The only there's no out of the model adjustments for the $300 child tax credit in the model. and I don't have a dummy for it. That's one of the key things is, well, Greg, why don't you dummy for all this stuff? And you get dummy variable paralysis very quickly if you try to put dummies for this stuff, and you don't know exactly when, for instance, the $1,200 adult, April 2020, you don't know exactly when that was spent on sales taxable items. It was very hard to populate dummy variables and build that into the model going forward. So I'm assuming that's baked into the history with the other federal stimulus. And I'll get into that when I get into the model specification. But to answer your question very directly, no, there is no assumption about the $300 child tax credit in the forecast.
In the Global Insight forecast.
Well, to the extent that it affects U.S. retail sales, and we think it probably does, it's built into the U.S. retail sales variable, which is a dependent variable in two, or exogenous variable in two of my models. So to that extent, yes, it's built in.
Okay.
It's also the personal income.
Michael corrected me. It's also in the personal income data, which shows up in my VAR and one of my structural models as well.
But they do not assume that it will be reauthorized in the future. They assume that the monthly payments will be received through December. Then the eligible families will receive the remainder when they file their taxes in, for April, due by April. And they do assume it is not renewed going forward.
Okay, that clarifies that.
Thank you.
You're welcome.
Just a second on this quarterly slide. I wanted to point out fiscal year 21 quarter 4, because that's going to be one of the comparables in my fiscal 22 forecast. And look at the $1,293,000,000 month that we had or quarter that we had in the fourth quarter, and that was 31.4% growth over fiscal 20 quarter 4, which was the pandemic quarter. So you expected prominent growth, 31.4%. But if you go back to the last clean year of fourth quarter, that would be fiscal 19 quarter 4, and then you do the proper compounding, that would be 11.2% growth from adjusting for the compounding since fiscal year 19 quarter 4, which was a huge quarter at the time. That was a high growth quarter, and we've still grown 11.2% off that. And if you remember the press release we did at the end of the fiscal year talking about sales tax, 11.2% is rarefied air in the sales tax. It's close to record levels of growth that you would see that have gone unseen since we've raised the sales tax from 5 to 6% in the early 90s. So I just wanted to show that to mention that's going to be one of the challenges to growth in the rest of fiscal 22 is getting over that fiscal 21 quarter 4 aided by stimulus quarter. So let me talk about how we updated the model. And so we had a new quarter of data, and I went back and looked at the forecast that I presented in August, which had the first quarter of fiscal 22 as an estimate. And we missed the estimate in that quarter by about $18 million. Missed it on the low side. So receipts came in $18 million greater than I had forecasted. So that, that carries through in the base. So if you look at the end, when we talk about differences from August, 18 million annualized is about $72 million. And that was the effect of the first quarter on my forecast. I reran the same models that I've been using for a while. I've tried some of the specifications that you all gave me during the last meeting, tried some of that. The first thing I really wanted to do was get these transfer payments that I showed on that monthly graph into an exogenous variable. And if you remember Michael's picture of Kentucky transfer payments, it looked like the peace sign. It had two big peaks and the rest of it was really low. And regardless of the sample size that I used, it did get better with shorter samples, but regardless of the sample size, I could not get transfer payments, Kentucky transfer payments, to be as significant, not even close to being significant. So I think one of y'all suggested, well, why don't you normalize the dependent variable like we did after expanding the base in 2019. But I really lacked the data to separate out the stimulus effects. So I couldn't do a policy neutral dependent variable based on the information that I had. I couldn't construct that. So what we did was we ran our structural models, our VAR, and our REMA, and those were the models that we blended. And the income variables I used were Kentucky wages and salaries, Kentucky personal income, and their US counterparts. I tried all those. Kentucky personal income actually includes transfer payments, obviously, so where wages doesn't. So whenever possible, I use Kentucky personal income. The only problem with it is it's a fairly monotonically increasing series, so it doesn't have a lot of variation to it, but nevertheless, when you difference it, it performs pretty well in a VAR. I used a global insight variable called state and local personal taxes that has served me well in the past. And then for consumer spending, I tried the consumer spending on durables, but I mainly relied on US retail sales because it has the most comprehensive view of IHS Markit's view on what's going to happen to retail sales. And just so you know, the VAR had the dependent variables were seasonally adjusted sales tax differenced and Kentucky personal income differenced. And then I used exogenous variables, retail sales, and US state and local personal taxes were my predetermined variables. Ultimately, I had four models, which I'm going to show you on the next graph, but I only chose to blend three of them. And I used Garch and Arch estimation techniques, as I mentioned last time, on the advice of some econometricians that I talked to that deal with autoregressive conditional heteroscedasticity and the fact that there's information in the residuals that can be used to potentially lower the variance and get a more efficient estimator. But here are the models that I blended. A little bit tough to see, but the model that got eliminated was the green model at the bottom. And I wasn't doing that just to bump the estimates up. I did it because the model, when you do the analysis to the first quarter, that model that we used last time performed the worst in terms of its contribution to the first quarter error. So I removed that from the blending process, thinking that it would artificially lower the forecast as it did in the first quarter. So I blended a retail sales different structural model. For the control, I blended in an ARIMA forecast, and I blended in the VAR model with difference data. So those are the pictures of my blended models. On this slide, I'm showing the control forecast growth rates, and you can see in the current year, I'm calling for 7.1% growth in the control forecast, and then 4.8% in 23, and then 3.4% in 24. I've added a slide. Well, I don't see it. Well, here's the control optimistic and pessimistic estimates that you can see here. The optimistic is obviously higher than the control. 8.2% growth in the current year versus 7.1, 5.5% in 23 compared to 4.8 in the control, and 5% in 24 compared to 3.4% in the control. And you can see the pessimistic comparisons as well. In the pessimistic and optimistic, I used only 2 models to blend because it wasn't appropriate to blend in the ARIMA model since there's no IHS market variables that add a difference between the control optimistic and pessimistic. So those are blends of 2 models instead of 3. I went ahead and did needs just so you can see what you're buying into if you choose control optimistic and pessimistic. Year to date, it's grown 9.9%. To hit the control forecast, I need the remaining 9 months of the year to grow by 6.2%. To hit the optimistic, I need the remaining 9 months of the year to grow at 7.7%. And on the pessimistic, I need the remaining 9 months of the fiscal year to grow by 2.9%. I show those just to give you some idea of what kind of growth we're expecting for the remaining 9 months of the year after growing 9.9% in the first quarter. That's really all I have for the sales tax. I can take questions, or we can continue to plow through to corporate and major business taxes. Okay, hearing none, I'm going to yield the floor to Jean Zapranic Brown for a discussion of corporate and property. Space bar, please.
Good morning.
Hi, Gene.
On my forecasts, I'm going to focus primarily on differences between the current forecast and what we talked about in August. I'm going to jump right in and look at the change from the August forecast to the current forecast. This is the difference between those forecasts in millions of dollars. You can see that there is a significant increase in the forecast under all 3 scenarios in the current year. There's large increases in the control and optimistic in 23 and 24, and smaller increases, and in fact, a decrease under the pessimistic in the last year. The reasons for these changes, there are primarily two factors. The first are the year-to-date receipts. Greg talked about them briefly. Through the first quarter, we are up 76% in these taxes. In July, we collected $34 million more than we did the previous July. In September, August, we collected 12 million more. And in September, we collected nearly $80 million more than we did the year before. So the first 3 quarters, we were ahead of last year by $125.5 million. Some of that money we knew about, but the September receipts, of course, came after our August meeting, and that was a surprise to us that we collected nearly $80 million more. The second factor is an out-of-model adjustment that we made. I'll talk about that more in just a minute. Let's look at the forecast changes for the U.S. corporate profits that I use. This is a control forecast. The blue is the current forecast. The red is the August forecast. You can see the new forecast beginning in 2022, the calendar 2022, and running through the first half of 23 has been lowered relative to August, but it's higher in the last year and a half of the forecast. We're going to look also at the alternative forecast. I don't usually show those because typically they are very similar to the controlled forecast. But under the optimistic, you will see, again, the blue is the current forecast. It's higher everywhere. And the gap between the August and the October forecasts gets bigger as we move through the forecast horizon. Excuse me. Under the pessimistic, again, the blue is the current. It is lower everywhere and significantly lower than what we were talking about in August. This is what I call it the October forecast. Of course, we discussed this a little bit. This is the October meeting, so I call it the October forecast, but it's based on the September IHS market forecast, where the control is bounded, of course, by the optimistic and the pessimistic. It's fairly flat and then increasing over the last 2 years. So this incorporates the out-of-model adjustment that I made. When I do a forecast, I consult with Greg, we review it, and we try and decide how reasonable it is. We did a needs estimate on the forecast, and the needs with what the model was kicking out was we could decline by 18.6% and still hit our forecast. So we thought that was going to be a little bit too low. We added $100 million in fiscal 22. We added $80 million in fiscal 23, and we added nothing to fiscal 24, which brought us to these estimates you see on the screen. So for the current fiscal year under the control forecast, we are currently 76% ahead of last year, or $125 million in the bank. The forecast calls for us to grow 10.6%. Under all the forecasts or scenarios in next year, in fiscal 23, we expect a decline ranging anywhere from 3 to 12.7%. And in fiscal 24, under all the scenarios, we're going to have moderate growth, 4 to 5%. I went ahead and did a needs like Greg did, and you can see, again, year-to-date growth is 76%. Even with the 200 and, let's see, even with a forecast that is 200 under the control scenario, $225 million more than we were talking about in August, we can still decline 4.4% over the remainder of the fiscal year and still meet this estimate. Under the optimistic, the estimate is an increase of 16.1%. We could grow 2.3% and we would meet that forecast. And likewise, under the pessimistic, the estimate is for growth of 4.9% in the current year. The needs over the next 9 months relative to the same time frame last year, it could decline by 11.4% to meet that estimate. That's what I have for the corporate and LLET forecasts.
I have a quick question. Hopefully it's a
Yes.
quick question. Similar to what I asked earlier, I guess I'm a little bit confused about the numbers versus the model. So if I just saw correctly, the one of the main variables you use is book profits and from the IHS and so on. From October, our latest one compared to what we were talking about in August, the book profits are actually shown to be lower, right? And
That's
yet
correct.
somehow the estimates for what we're going to collect are massively higher. And so I think I understand, because it seems from your explanation that, and by the way, this is a good thing, right? For collecting all this money. It seems like it's mostly from this recent quarter that was so much higher, 76%. I just want to make sure that something hasn't happened in the last 3 months. I doubt it, but where places have put up a whole lot of money in the last 3 months, and then all of a sudden in the last 9 months, they're not going to make up and everything's going to be drastically lower. I don't understand. I guess my question overall is how has IHS got us doing less, but we're going to end up, our model says we're going to collect a whole lot more. Were we that far off in August, or has something else happened?
Well, it's mainly, you're right. First, let me say you're right that there's always the concern that the declaration payments are going to be high. We get to the end of the year, that's going to go back out in refunds. We collect, in the fourth quarter, we collect almost 45% of the total revenue in these accounts in the final 3 months of the year, and most of that's in June. So we never really know what's going to happen until we get to the end of the year. That's always a concern. In August, we talked about there was about $80 million last year that we received in accelerated, well, I shouldn't say accelerated, in estimated payments that were a surprise that several companies had made that were well beyond what they'd ever paid. We checked back in with revenue, and not only did they not ask for a refund of that money, they're continuing to make large declaration payments. Now, that's only a few companies, but that indicates to us that it's not the case that corporations are making these large declaration payments and that they're going to go back out as refunds. So the other part is, yes, the forecast is a bit lower. You're right. And so that should bring us down a little bit. A lot of that has to do with this $125 million that we've already have in the bank through the first quarter. There's always a bit of a disconnect. This is the corporate profits that we use. It's really the best thing we have to look at to forecast. But there's always a bit of a disconnect between what we collect, excuse me, and what the IHS forecast is. So I think just when we looked at it, excuse me, that we thought that a decline over the next 9 months of over 18% was really just going to be a little bit too much. I'm sorry. And we thought it was, I guess, prudent or the best to go ahead and add that money in. Of course, now when we meet in December, we'll have a little bit more data, but I'm sorry. But October and November are not particularly large months for collection. So we're not going to have a lot more money or a lot more information or good information. They're not some of the larger months, but we wanted to go ahead and put that money in now rather than and let you think about it, and we'll kind of look. I will say I looked at the daily receipts this morning, and again, October is not a particularly large month, and we're only in the middle of the month. So I don't like to read too much into it, but we are about $10 million ahead, thank you, this month compared to last month. So it seems to be that trend is continuing, and we think we're going to do a little bit better, even though the forecast for the profits is lower.
Okay, thank you.
If there are no other questions, I'll move on to the property tax forecast.
Just a minute, Gene.
Yes.
Do we wish to take a short break right now, or do we want to continue without a break?
I'm fine, but if the members would like a break, that's fine.
Can we hear from anyone?
Sure, I would support
Frank,
a
do you
short
need a
break.
break?
I would make a motion for a break.
Yeah,
Okay.
let's have a break.
10 minutes.
Awesome.
Okay. Let's try that.
Yeah, it's an easy way to mute it without getting out of everything. Thanks.
damn it. Mhm.
We're back. Click on this. Oh, shoot. I did not mean to do that.
Yeah, just go single slide.
Oh, it's a single slide. I'm sorry. Okay. It also, apparently the mouse roller moves slides too.
Okay.
I've been using it.
I have two.
Excellent.
Thank you.
So when are you guys going to move out of the mailroom?
Monday is the day.
Oh, okay.
So we're trying to finish up packing today and tomorrow, and
Good. Are the new digs fancier than the old?
I've already heard the answer to this question.
Oops. Hmm.
I've not seen it, but I think it's a cube farm.
Hmm.
We've been blessed to be in the annex for so long. We have good quarters over here.
Yeah.
I would
Yeah,
like
see-
to point out how polite you both are. So polite.
Are we ready to continue, or are we still waiting for a few?
There's Alan.
I think Alan is back. John is. Yeah, why don't we go ahead? John will
Okay.
catch up with us.
All right, thank you. Before I get started on property, during the break, Greg did mention Budget Director Hicks just came back from the National Association of State Budget Officers meeting, and they're all reporting strong growth in their corporation income taxes as well across many other states. So we're not, it's not unusual here that we're getting large increases in those receipts. So for the property tax forecast, there is no change to the August forecast. We've talked about this before. The majority of the property taxes come November through January, February. A lot of that is mainly because of the real property tax. And we haven't received any of those revenues yet. So just a few notes on the property tax. The August estimate was for $711 million, or 1.2% growth in fiscal 22. The growth rates for 23 and 24 were 3.5 and 3.3%. Currently, we're up 16.5% year to date. I should point out that we've only collected about $65 million out of that estimated 711. So even though year-to-date collections are running ahead of forecast, that's not a concern. So again, we don't have enough information to justify really any of the changes to the accounts. There is one we can look at, and that's the motor vehicle tax, the property tax. It comes in monthly. The estimate was for a decline of 1.1%, and we're essentially flat year-to-date. So we feel like there's no need to make a change there. You will see if you look at the receipts report that the tangible account is running about $10 million ahead. That is for the telecom property portion of the property tax. I reached out to the Department of Revenue. They indicated that the bills went out earlier this year, and they think that's just an acceleration of receipts. In the past, that money had come in October and November. So we think by the time we meet in December, that account will be on track to where we think it's going to be. So given all those factors, there is no change in the property tax forecast from August.
Thanks, Gene.
I'm returning to talk about the cigarette tax. The fiscal 20 tax revenues were surprising in that they actually grew 0.4% more than fiscal 19 with no change in the tax rate. So getting growth with no change in the tax rate implies an increase in consumption, which is what we saw in fiscal 20. Fiscal 21 was 1.4% lower than 20, which is at least the right sign. We expect a negative, and we got a negative in 21, that is. Fiscal 22, we're down 4.4% in the first quarter. My field experts on this, I have some people I call who are wholesalers, and I used to talk to some folks at the Department of Revenue who have retired, so I rely more on my field experts, and they say that what's going on right now is that prices are rising on most cigarette brands, the majors, at least, the prices are rising. 2020 was a very high year for profits in the major tobacco companies because they're able to push these higher prices onto consumers. But what we're seeing, so higher prices lead to less consumption as a general rule. But what we're seeing, according to the field folks I speak with, is movement down the product line to combat higher products. In other words, buying lesser brands of the same, either the same manufacturer or changing manufacturers altogether to combat the higher prices. Ceteris paribus, that's good for that is a good thing for cigarette receipts because it's not a value tax. It's not. It's a per pack tax. It's a
Excise tax.
it's an excise tax and not, it doesn't have an ad valorem component to it. So moving down the product line combats the fact that prices are rising. So we don't expect, in Kentucky, we don't expect as much decline as maybe you'll see nationwide. And I did disband with the optimistic and pessimistic view of cigarette taxes because I really didn't have a model that had IHS market variables in it that you could do a meaningful pessimistic and optimistic. So what I'm depicting here is just our control, which is used in all three scenarios when we get to our balance sheet, and that's a 2.5% decline in 22. A 2% decline in 23 and a 2.3% decline in 24. And so modest declines, a little bit more of a decline than we saw in fiscal 21, but we'll reevaluate the situation before December and get, our final cut, but that's where we're standing right now. Very small changes from what we did in August, but actually the control numbers we're using for October were closer to the pessimistic numbers we used in August, and that's due to the first quarter results of negative 4.4%. So that's cigarettes. We know the sign's going to be negative. At least we're pretty sure the sign's going to be negative. It's hard to pinpoint whether it's going to be negative 2.5% or negative 3% or negative 2%, but those are the estimates, and we'll refine them in December when we come back and do the official estimates.
Okay.
The Kentucky Lottery is the next account I want to talk about, and we talked about some of this stuff last time, but I want to talk about it again because the as you'll see on the next slide, there's an apparent incongruity in the fact that sales are rising and the dividends falling, and I want to be clear on why that is occurring and the changes going on in the Kentucky Lottery. So fiscal 21 was just a phenomenal year, and that led to the 289.1 general fund dividend that we got. We did, pursuant to the budget bill, get a total of 347.1 because 58 million was added to a non-general fund account to be specified by the General Assembly as to its use. So the total dividend was 347.1, even though if you looked at the receipts report, it was 289.1. But in terms of ticket sales and sales, they were, fiscal 20 was just phenomenal. We're up close to 30% in instant tickets. Draw games were up close to 18%. And the iLottery, while last year was only 118 million out of roughly 6 billion in total sales, it grew 256.7%. And the return to players on iLottery is about 85% or slightly higher. So growth in that into the future is one of the reasons why we're going to have growth in sales and not an immediate growth in dividends. But total ticket sale growth last year was a phenomenal 31.8%. It was just not too long ago when the lottery was peaking $1 billion, and we're already, as of last year, up to 1,586.3 million. So getting to the dividend and ticket sales, we do expect a little bit of growth in fiscal 22 over the phenomenal growth that we saw in fiscal 21. The innovations that the Kentucky Lottery is doing are leading to the ability to sell more tickets. If you look at the specifics of their sales tax project or their ticket sales projections, what you see is a slight drop in draw games. You'll see a fairly sizable dip in instant play. There was 961.7 million. That's the highest of all their categories was instant sales. 961.7 last year, and they're only projecting about 897 million this year. And so a drop in instant play, a drop in draw games. The big increase in sales, the reason we're going up actually is iLottery. In the iLottery category, we set a big record last year of 118.6 million in sales. This year we're projecting 190 million in sales, which is phenomenal growth. So that's leading to the ticket growth in the year fiscal 22, but the dividend does not reflect the very slight growth we had in ticket sales because the payout, the prize expense, I should say, from iLottery is the highest prize expense across all the lottery products. So we're expecting an 8% decline in the dividend transfer in fiscal 22, and then we'll resume growth in fiscal 23 and fiscal 24 once we moderate from that huge year in fiscal 21. But while it seems somewhat counterintuitive that we're going to have ticket growth in the next 3 years, and the dividend is just going to reach 347 again in 24, it makes perfect sense when you look across their offering of products and their projected sales. And I've gone through the financials and agree with the analysis of the Kentucky Lottery Board, and those are the dividend projections that we have for now. If there's any questions about the lottery, I'll take them. Otherwise, I'll move to the other taxes. The miscellaneous other taxes, I'm not going to go through the lengthy discussion I had in August. I will concentrate on the changes we did since August. The biggest change, of course, is the $225 million settlement check we received pursuant to the legal settlement with Flutter Entertainment, which is the parent company of Poker Stars. We got a $225 million inflow that hit the books in September. That's why September receipts were so high. One of the reasons September receipts were so high. That money hit miscellaneous revenues, which is a part of other taxes. So other taxes, if you remember back to August, we were saying other taxes were going to fall in 2022. With this 225, obviously, the fall has turned to an increase, and I'll show that to you in a minute. But that's the single largest adjustment since August. Obviously, $225 million unexpected settlement. There was also a downgrade to the insurance premiums tax. We talked that over with the Department of Revenue and decided that a downgrade to insurance premiums tax. We took some money out of the current year, and there was some money that came out of 23 and 24 as well due to the lower base. So insurance premiums tax was a haircut on my spreadsheet. And there was a small upgrade in pari-mutuel tax receipts. We had a phenomenal first quarter. And based on the first quarter receipts, I went back to look at the historical horse racing part of the pari-mutuel tax. And in particular, the pari-mutuel receipts were increased because of higher expectations of the historical horse racing segment of that tax, the pari-mutuel tax. So all that sums up into 22. Remember last time we talked about the bank franchise tax and how that was going to drive the 22 numbers down. Well, the bank franchise tax still is $124 million drag on 22, but the 225 million plus the other changes swamps that. So we're expecting 987.3 million in fiscal 22. Obviously, that's going to lead to a large decline in 23 because we won't have that one-time $225 million settlement. So you get a big decline in 23 and then back to sort of normal growth in 24 is what we're looking for. This is a culmination of about 65 individual accounts that we reevaluate. I looked at the numbers after the first quarter receipts, and most of the categories were in line with expectations, except for the insurance premiums and the pari-mutuel. So that's the forecast for other. We'll take a deeper dive and show you more detail in December when we do the official estimates. But that's where we stand right now in other receipts. That's really all I have, except for a different slide. The difference is 208 million in 22, and then a slight decline in 23 and 24, mainly due to the insurance premiums tax haircut that I did.
Okay.
I did, usually at this time, Mr. Chairman, we pull up a spreadsheet and start talking control optimistic, pessimistic, and doing some blending. But I did want to make a few remarks, looking at it from the treetops instead of through each individual tax to maybe put the forecast in a little context. If I fail in that endeavor, I apologize. But I did have a few different ways to look at it. You may remember when Buddy Street was on the CFG back in the 90s, and he would always look at the general fund holistically and want to know how is the general fund growth that we're projecting compare with historical periods. And so I went ahead and did that. And if you use compound annual growth rates and the control forecast only, what we're calling for in the biennial forecast is about 3.4% compound annual growth rates for the current year and the upcoming biennium. If you compare that to some periods in the past, fiscal 15 through fiscal 21 is a 6-year compound annual growth rate period. And that was a 4.3% regime of taxing increase in general fund tax receipts. The number is higher mainly because 21 was such a huge year. If you take out 21 and you recalculate a 5-year compound annual growth rate instead of a 6, that 4.3 would have been a 3.0. It's I don't know if it's fair to take out a year and look at it that way, but I'm just saying the math. If I showed fiscal 15 to 20, it would have been 3.0 instead of the 4.3. Same with the 11-year period from fiscal 21 to fiscal 10 to 21. That 4.1% would be 3.5% if you took out and just did it from fiscal 10 to fiscal 20. I figured that, you know, ending it on 20 would be just as biased as ending it on 21 because, you know, 20 did have some a lower quarter due to the pandemic. So I just kept with what I thought was the fairest measure. But you can see that growth is consistent with, albeit slightly lower than the two historical years year spans that I chose to depict.
Greg,
Yeah,
Greg, going back. So, I mean, no, that slide. So, you know, you said, you know, ending it on 20 versus 21, you know, the clean ending in a sense is 18, right? Because that's all pre-pandemic. Do you have a
Yeah.
sense for what those numbers would look like if you ended it on 18? And I know, like, now I'm asking you to do a lot of things in your head very quickly, but
if you ended it, well, if you went through fiscal 18, if you did a fiscal 15 through fiscal 18,
yeah,
you would be down. It's in the three range.
Okay.
But I don't know where in the three range it is. And as I told you, fiscal 10 through fiscal 18 would have been, I dare make that projection in my head, but
fair enough.
it would be in the threes somewhere.
Yeah.
So I can compute those and while we're doing the road fund and get back to you on them, but they would be in the threes. So I think the growth that we're calling for in the control forecast is roughly consistent with historical periods, is what I'm trying to say.
Yeah,
And
that was kind of what I was trying to get at is, you know, I know in other things I'm doing, I'm just basically stopping everything at the end of calendar 19, which the equivalent here would be, you know, fiscal year 18. So, or the closest equivalent, because like, I mean, like, I don't even know how we deal with the current in forecasting, but okay, thanks.
Yes, sir. Another slide that may or may not hit the mark is differences in the entire forecast versus the the August consensus. And in its entirety, the fiscal 22 difference from August consensus is $641.1 million. If you adopt the control, you're going to be 641.1 million higher than where we pushed away from the table in August. You know, 225 of that is the
I'm sorry.
settlement.
Greg, can you remind me, well, or can you tell me, since I wasn't here, was the August consensus control, optimistic, pessimistic, some kind of blend, just really roughly?
It was 100% control. There was some talk about maybe doing a little bit more optimistic in 22 since the growth rate was only 0.9%, but ultimately we adopted the control forecast for 22, 23, and 24 for both
Okay.
the general fund and the road fund.
All right.
So you can see the range of what we're going to add today, if we choose the optimistic, pessimistic, or control, would be 461.7 in the pessimistic, up to 752.4 million in the optimistic. So fairly substantial increases versus in the current year versus what we said in August. Again, that's I think in a lot of cases primarily due to that great first quarter, but and you can see in 23 and 24 the differences between what we'd said in 23. The important part, you know, I think in doing a 23 and 24 estimates is nailing that base down, because our growth rates, I think, are believable from 22 to 23 and 23 to 24. It's just getting that base correct. And so you can see the differences since August for 23 and 24. Another way to look at what we just talked about, it would be the needs to hit the alternative scenarios. The general fund needs, if you take all the taxes in their entirety, the control forecast has a needs of 1.8%, meaning that the last 9 months, if they grow at 1.8%, we would hit the control estimate. If they grew at 3.0%, that we would hit the optimistic forecast. And if revenues were flat in the final 9 months of the year, the pessimistic scenario would be would come in. I show this just to remind us, when we're talking about needs, we're talking about needs of growth over the second, third, and fourth quarter of fiscal 21. And I showed you in the sales tax how much growth we had in the third and fourth quarters of 21. Some fairly high hurdles in the sales tax, I know, but just in general, the third quarter and the fourth quarter were very historically high growth quarters, especially the 24.8% in the fourth quarter, albeit against the COVID pandemic quarter, but that didn't fall that much really on the revenue side due to some of the stimulus. So the 24.8% is a formidable hurdle in a lot of taxes. So that's why the needs, the seemingly low needs that we're calling for don't appall me as being easily jumped over just because of the growth in the last half of last year. So those are just some of the things that came to my head when looking at the general fund as a whole. So with that, what we typically do is pull up the spreadsheet and have an economic discussion about control optimistic, pessimistic, and allow you to do some blending. So I'm going to pull up our spreadsheet.
The main risk to this forecast is going to be how well Global Insight has predicted going forward. And
yeah, absolutely. Michael, is Michael here?
When you're talking about pessimistic versus control, you're talking about $200 million one way or the other.
Just a second, sir. I'm trying to get this spreadsheet up.
Okay.
Hey, Frank, while he's doing that, I guess I have a question for the group.
Mm-hmm.
One thing that I didn't really see discussed, and maybe I missed it in reading quickly through the IHS stuff, is I know they talked about the infrastructure bill, but as we all know, there's this budget reconciliation bill circulating out there of have large implications for certainly government spending, transfer payments, et cetera. And as we've just observed, despite high unemployment, large government transfer payments are actually good for state tax revenues. And so that's one thing I think that as I think about our forecast for the outer years in particular, that's kind of going through my head is if some version of that passes,
Share this window.
How does that translate into state revenues as well?
Yes. That's a question that's not addressed at this point. And I suppose the one comment I would make is that it will be addressed by the time we meet in December, I hope, as to whether that's going forward or not. The second is how quickly those effects are going to feed in. And, one would have to study that. That's why I was asking about the child tax credit and whether it was going to continue or not. But
Right.
it's
And obviously, you're right, there's a lot of uncertainty around that. And you're right, December is their target. So depending on when in December things shake out. So.
But go ahead.
I'm showing our normal blend sheet. There's a line right under total general fund that shows what the growth rates would be without the $225 million. And fiscal 23, appears weak at 1.2%. But if you take out the $225 million from fiscal 22, the growth in 23 would have been 2.9% instead of 1.2%. And the growth in the current year would have been 3.9% instead of 5.7%. Just if that helps you wrap your head around any of it, but this is our typical blending sheet, and we would certainly seek your input at this point.
Right now, I still feel that the control is doing a good job, but I'd like to hear what the rest of the committee thinks.
So
I just agree with Jose. I can't see going with an optimistic, although I don't think that matters because it's not that different.
Right.
I have a hard time going with the pessimistic, although part of me wants to hedge just a little bit against who knows what the heck's coming down the pike next, but I like the control.
other folks?
I've heard nothing to change my opinion. Yeah.
Yeah, neither have I. The control looks good.
I'll jump on the bandwagon and be controlled as well. Nothing has moved me. All interesting, but lots of uncertainty.
So Kathy?
There's so many things that'll make it go up and things that'll make it go down. Because I was looking at things like, the impact payments won't be around, but they weren't taxable, so they didn't affect it. The uninsurance payments, they are taxed and they'll be gone, but we have fewer people working. And so they're going to have to make more in order to make up for that, I believe. I think there are going to be incentive payments from firms, what's higher on that, I don't know. And they were still going in the first quarter, but they're gone now. And then I was looking at the sales tax. Yeah, I'm not as positive that inflation isn't going to be higher than 2%. I know the Fed chair is optimistic about that, but I'm not. When you look at just how big their balance sheet is, it just doesn't seem possible that there won't be some sort of inflation. But I was wrong on the recession, in the Great Recession, so I may be wrong again. So there's so many things that you could say, oh yeah, it's going to go up. But then other things you can say, yeah, it's going to go down. The supply chain issues, when are those going to, how transitory are they? Another thing I was thinking about is, we have a really high first quarter receipts, but we're saying that the rest of the year doesn't have to grow much in order to, make our target. Does that make sense? I don't know. So I'm happy with the control as well. I guess if I were going to really go with my gut, I'd probably be oh, I don't know. I might lean a little bit more pessimistic. But then tax revenues are based, inflation's good for tax revenues.
Yeah.
Yeah.
So, who's left to comment?
I think
David?
I am. Kathy, I think that
Oh,
was
I'm sorry, Alan. Yes.
No problem. Kathy, I think that was a great summary. I agree. I think I'll start with how you ended. I think I'm probably leaning a little bit more pessimistic just because, as Chris said earlier, we're trying to go from what happened a year ago, which was none of us could really fathom, to year by year comparisons to where we are now. I think it's really difficult to make those comparisons. I've asked several questions. I still have such a hard time figuring out if some of what we thought about 2 months ago isn't quite as nice, but we're still thinking about collecting a lot more. But the short is that, Greg, I appreciate when you, especially for this current year, when you say what we have to catch up or what we need for the next 9 months. So I would probably lean more pessimistic theoretically, but practically, especially for this next year, I'm probably super fine with the normal, I guess, because we have so little. The first 3 months were so good, it seems like it would be hard not to get what we need to make up for those last 9 months to be able to meet it. And so the legislature really needs the end result more than our theoretical. So I think the end result was probably pretty close to the consensus.
So we are going with control. Does I hear it?
Yes.
Okay.
Yes.
All right.
Yes.
Yes. I'll say I was more pessimistic last time and I was kind of proven wrong by the data. So that's why I edged towards control this time.
Well,
But the control's more optimistic than it was last time, it looks like. So you've moved a lot then toward optimistic.
I was
Okay.
severely outvoted.
All right.
Greg?
Would you like to go to the road fund then, or?
Yes, John will note what we've agreed to, right? Is John connected? John Ronker?
Yes, I'm here.
Oh, you're here, and you heard all this.
Yes, we have it recorded.
So, good, thank you. So you'll prepare a letter on this matter in due course, right?
Correct.
No, do we transmit this information this time? We do? We're not making any official changes.
Yes, we will. We will
No.
transmit that information.
Okay.
Statute requires us to notify the three heads of the three branches of government.
That we've met and talked.
Yes.
Okay. Yeah, sorry. Greg, go ahead with the road fund.
Okay. Is the title screen for the road fund still on your screen?
No.
No. We have a blend worksheet.
Is it up there now?
Yes.
Okay, thank you.
Okay.
So I'm going to take a similar approach to the road fund that I did on my others. We're going to look primarily. Yep, there it is. We'll look at the differences between the August forecast and the current forecast. The only other thing I'm going to do a little differently today than I've done in the past is I'm going to focus on the motor fuels estimate as well as the motor vehicle usage estimate. And then the remaining accounts, I'm going to look at those as a group. I'm doing that because they tend to be smaller with less variation. And so I'm going to look at those all together today. But when we come back in December, we'll break those out and look at those individually again. So bottom line difference in the forecast from August under the for the current year, small increases anywhere from $3.9 million to $19.4 million. And then in the out years, declines under all scenarios, relatively big, $20 to $60 million, depending on the year and on the scenario. So we will look at the motor fuels forecast. I look at the fuels consumption. You can see the red line is the October forecast relative to the August forecast. This is the control scenario. I'll focus primarily on the control and less on the alternative scenarios. Still pretty flat, but at a lower level than we were seeing in August. These are the three scenarios, control, as well as the pessimistic and the optimistic. Again, they're all fairly flat, some decline in the control scenario, which is the blue, but not, no big increases or decreases. So in terms of the fuels estimate relative to what we talked about in August under the control, optimistic and pessimistic, again, like the bottom line, increases in the current year and decreases in the 23 and 24, regardless of the scenario we choose. I should point out, I didn't talk about the average wholesale price today. They do that 4 times a year. The first month of the quarter in July, that amount was 226.4. Keep in mind that the floor is 217.7. So anytime the average wholesale price increase is higher than the, or is above that 217.7, we're going to get an increase in the tax rate. We're currently in another survey month through the first week. That is $2.31.1. So when we look at where we are currently, that would put us above the floor, which would increase the tax rate. When I do the forecast for the average wholesale price has this bumping up just to the 217.7. So the forecast for the price of gasoline, which I use, had it peaking at the end of the last quarter and tapering off. So that's why my forecast, even though we're currently above the 217.7, at the end of the year, when we average out the 4 quarters, it has us at 216.7. So we're slightly below the floor that would cause a rate increase. For 23 and 24, that number is going to be lower yet, to $2.11 in 23 and $2.05 in 24. So the bottom line is, while we're currently looking at a potential increase in the tax rate at the end of the year, the forecast is that we will not have that tax increase. I'll show some slides on that next time, and I'll look at the forecast in depth on that when we meet again in December. So in case anybody sees that or is aware of the survey months, the current forecast is not for a price increase.
Hey, Gene, on that point, I'm sure you're aware current gasoline futures are pretty flat from today's levels, so not slightly increasing. So
that's correct. That's what
translate into the wholesale price of gas that you use, but at least the futures market is not showing some decline until well into the fall.
correct. And that's the problem, I think, that we talked about earlier. This is the September forecast, which was no doubt prepared in August. My guess is that once we come back in December, that that forecast will be significantly different, and we will see an increase in the tax rate. I do anticipate that.
Thanks.
Thank you. Consumer spending on new vehicles, light vehicles. This is what I use for the motor vehicle usage tax. Again, the red line is the current forecast, lower everywhere relative to what we saw in August, which is going to lead to a decline in the forecast. I do want to point out, this may not look exactly like when Michael talked about in his slides. I use consumer spending, so total spending on vehicles when Michael shows units sold. Probably a similar shape in the graphs, but not necessarily going to be exact. So in case you're wondering why my graphs might look a little different than what Michael showed, it's the difference between spending on vehicles and unit sales. Then these are the three scenarios. For those, so let's look at the change in motor vehicle usage tax relative to what we saw in August, again in millions of dollars. Under the control and the pessimistic declines in the current year, although the optimistic has a slight increase. And again, we see in 23 and 24 under all scenarios declines ranging from about $17 million to $42 million. Now, all the other remaining accounts are the motor vehicle license, the operators, the weight distance, the investment, and the other. There's not much variability between these, and two of those, the investment and the operators, we don't have alternative forecasts for those. So looking at those as a group, the change from August, fairly small. They're all increases for the current year, approximately $4.5 million. Next year, $1.5 million to $2 million, and slightly more at roughly $8 million for those accounts as a whole. So looking at the bottom line, the fuels and the usage with the August forecast on top compared to the October. In August, we had 2.6% bottom line. We're now calling for a 2.9% increase, with the fuel slightly higher and the usage lower. Same holds true for 23 and 24. We were 0.9% increase in 23 in August. Now we have a decline. We do have the fuels, the rate of growth more in line with kind of historical averages of 1.2 and 1.1% compared to what we were saying in August at 3.8 and 2.8%. And we do have declines in the usage tax of 7.1% and 4.8 in the 2 years. That's all I have for that. If you want to, we can pull up the blending sheet to look at more details, or unless anybody has any questions.
Okay.
Blend away. It's on control. Gene is correct. Bottom left is the blend tab. All right.
Oh,
Let me change the weights a little bit.
all right. Looks better.
Can you remind me, was August control as well?
August was control.
I don't recall our doing anything other than control in the past 20 years.
I think the main thing is going to be that December look at the fuels tax rate that David Sinclair was talking about. We should have some more updated information from IHS Market, which could potentially affect the fuels tax. But I feel like with the information we have, both the fuels and usage have been right-sized properly.
So we have other comments.
I'm interested in a question for it's probably more distant than this forecast, but is there any discussion in the state about changing the way we tax road usage with the advent of electric vehicles?
Yeah, from my perspective, there's been a lot of discussion on it. Not much movement on it, obviously. We've looked at legislation in the past. There have been different proposals for how to, get at the fact that we're changing from a internal combustion world to a electric and at least hybrid world, and the use of fuel is going to go down, and the ability of fuels to fund the needed repairs on the roads may be in jeopardy pending the wholesale price of fuel. But been a lot of discussion. There hasn't been any action.
Okay.
The Europeans are somewhat ahead of us, I think, in this, because they've got a much heavier reliance on fuel taxes.
Mm-hmm.
Yeah, just quick.
And they're further along with the electric vehicle use as well.
Yeah, just quickly, in the last year or two, they did have a task force, I guess in the Transportation Committee, and they've brought in people from other states to talk about alternative taxing situations, but I don't know that anything has yet come of that yet. It's been more information gathering.
So probably nothing going to affect us before fiscal year 24.
Right.
That's possible.
That's plausible, I think. Yeah. So have we settled on the control for this?
Control.
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 Yes.
Control.
Okay, John and I'll duly note your preference on that. And we do have one last remaining piece of business, which will be fairly short, but we do have to talk about the MSA, Master Settlement Agreement for Tobacco Payments. So I'm going to bring Michael back up for one slide, I believe.
That's right. Oh, real quick. Let's see. Hate to go through the whole process, just to share one slide.
You start from the beginning.
Oh, no. I apologize. I did not mean to do that. Yeah. Terribly sorry. From the current slide. sure why it's not sharing. Is the MSA slide? Really?
There
All,
it
this,
is.
all it came up?
Yes.
Yes.
Okay,
It's
good.
it's not maximized, Michael.
You want to set it up, yeah.
So there's an awful lot of ridiculousness for me to say there's no change from August. I mean, literally, it's not letting me do it. I guess if you're going to fail on the last slide. So how about this one? Let's see if that works.
Something's loading.
Yes.
That's the title slide.
And there you go. And the estimates are the estimates are exactly the same. We have not received any new information that would cause the MSA slides to be changed at today's presentation. However, I do anticipate by December we will hear some updated information, and the numbers probably will be changing then. So, but for now, there's no reason to change the estimates from what were presented in August. But I do anticipate the numbers changing in December. Awful lot of work to say that.
Okay. Thank
All
you,
right.
Michael.
Very much so. Always like being the end of the show. So with that being said, I'll turn it over to Greg for any final comments or questions. I'll stop sharing that screen. Thank you so much. Hope everybody has a wonderful day.
Thank you.
Thanks.
Well, Mr. Chairman, that's all the prepared remarks we have.
Okay. Well, then I believe we have finished for the day, unless someone has something to add. I want to thank everyone for
Thank you.
participating and providing us with all the information as well. So we shall see you in December.
Yes, sir.
Excellent. Looking forward.
Bye-bye.
Thank you, everyone.
Look
Bye.
forward to it.
Take care.
Thanks.
Bye-bye.